There are five key financial metrics to consider when you're considering a HECM, a home equity conversion mortgage. And here to talk with me about this is Robert Klein from the Retirement Income Center. Robert, welcome.
Thank you, Bob.
So we're eager to have you walk us through these five metrics, but first I think there's some definitional things we have to cover.
Yeah, I wanted to distinguish between a HECM and a HELOC because a lot of people are familiar with HELOCs, but not necessarily with HECMs. Basically, a HECM is designed to unlock home equity for homeowners as needed through a readily available credit line without the downsides associated with a HELOC. And those include, first of all, access for a specified number of years, typically 10, required monthly payments. The lender can freeze or cancel your loan. A home is subject to foreclosure if minimum payments aren't paid, and there's a requirement to repay the loan in full, even if the borrower owns more than the home is worth. And let me just briefly touch on that as far as a HECM is concerned. With a HECM, when the home is ultimately sold, there's no need to make up the difference if it's upside down. If the mortgage exceeds the value of the home, that's covered through FHA insurance. And then there's one more difference, which it could be the most important difference. With a HELOC, you might not qualify for one when you most need it during retirement. You're not have the sources for repayment that are required to qualify for a HELOC. But the point is, all homeowners should, whether or not they have a mortgage, evaluate a HECM when they turn 62, because that's the qualifying age.
Right. And we can get into some of the reasons why you might want to have a HECM, but I'd love for you to walk us through these five metrics that you've established in terms of evaluating whether to get a HECM or not.
Yeah. So there's five metrics, and the way I came up with them is they're generally, most people don't use a consistent system or process for evaluating HECMs. They are familiar with a couple of things and we'll put emphasis on those. The point of this is to provide a process that anybody can use in any HECM situation to evaluate the HECM. So starting with the first one is the projected mortgage balance. Most people are familiar with that. And in all cases with these five metrics, what you want to do is stack them up side by side with your existing mortgage, assuming you have one, or even if you don't and you're planning on adding a HECM, you can come up with an amount that you would like to use for be comfortable with to draw on for a credit line from a HECM. But so with the projected mortgage balance, most people going into retirement still have a mortgage, and oftentimes it's going to go on for several years, maybe 10 or 20 more years. And once again, even if you don't have a mortgage balance or it's a minimal balance, you should still consider a HECM if you're 62 or older, if access to tax-free liquidity is important to you or will be important to you during your retirement. And there's two primary advantages of a HECM over a traditional mortgage, which is otherwise known as a forward mortgage. First of all, there's no required loan payments. And second of all, you have ongoing access to a tax-free line of credit that will increase by the loan interest rate, as well as any elective payments that you do make on the HECM. That's metric number one. Metric number two is projected savings. Whenever you're making mortgage payments, you're using money that could otherwise be used for other purposes. So to the extent you have a HECM available that doesn't have required payments, that frees up the money that you were previously using to pay a mortgage. And you can use that for savings or for other purposes. Metric number three is projected net worth. As it pertains to a HECM, it's equal to your total mortgage balance, which is you always have to refer to that as a negative amount because it drains net worth. plus projected savings, plus your projected home value. That's your projected net worth as it pertains to a HECM. So through these first three metrics, most people are familiar with those. Where it gets different is with metric number 4, where you're looking at a projected line of credit. You might be familiar with a HELOC, but the projected line of credit works a little differently with the HECM. And one of the advantages of the HECM compared to the HELOC, as we previously stated, is the ongoing access to a tax-free line of credit. And once again, it increases by the interest rate on the loan and any payments that you decide to make on the HECM. And one of the strategies that can be used with a HECM, even though you're not required to make payments, is to continue making payments that you were making on the mortgage. And not only will that pay down the loan balance, that will increase your credit line. And so that's number 4. Metric number 5 is liquidity. And combined, when you look at number 4 and number 5 combined, those two are the most compelling factors favoring the use of the HECM as a retirement income planning tool for prolonging the longevity of retirement assets. So what is liquidity as it pertains to a HECM? It's equal to the total of 2 of the previous metrics. Number 2, the projected savings, and number 4, your projected line of credit. When you add those two together, you have projected liquidity and the ability to readily access funds from savings as a result of not making payments, combined with a readily available tax-free credit line during one's retirement years, especially when alternative sources of income may be few and far between. This distinguishes HECMs as a unique retirement planning solution.
Right. And you've created a scoring system to help folks determine which option to choose.
I have, yeah. And the scoring system assigns points to each of the criteria for first, second, or third place. And I make the point in the article that you should not go solely by the highest score, because that might not be the best strategy in your situation. You need to go beyond that to see what's most important to you. So, just as a quick example, you might have a HECM that you're looking at where you're going the traditional route and you're not making any payments. And so that is great from a savings point of view and liquidity point of view. However, it might behoove you to continue making payments on a HECM that you were previously making on a mortgage, because that will inevitably give you a much larger credit line if you start early and keep doing that consistently. And so if that's the most important criteria to you, to have a higher credit line later in retirement when you might need it for, let's say, long-term care expenses, that could be the way to go. But it does start, as you pointed out, Bob, with this scoring system that I've developed. And by the way, it should be mentioned that it behooves you, if you're considering a HECM, to go through the illustrations and the spreadsheets in the article. It'll give you a much better understanding of how this all works.